And opinions expressed during the related show are those of the show personalities and guest alone, and not those of Vic Canellis Media Group, its parent, affiliates, or stations. VCMG Live is not responsible for any content, information, or opinions expressed. User bears full responsibility for their reliance on such content, information, or opinions.
Making money with Laura Sanders, a name you can trust. With over 20 years of real estate experience and selling over 150 homes a year, Laura Sanders is the #1 RE/MAX agent in the state of Florida for 2021. Join us each week as we discuss how to make money through buying and flipping homes, to renting versus selling, and everything in between. To join the conversation, call in live. 888-994-4995, Studio A.
Hi, everyone, and welcome to Making Money with Laura Sanders, and I am your host, Laura Sanders. So every week we talk about something that can help you make some money or help you with investments or know a little bit more about what's going on in the real estate world. Doesn't always have to be about real estate. It could be about travel. It could be about any number of things. So one of the things that I thought would be really good to hear is to talk about what makes more sense. Does it make more sense to put your money in the market? Does it make more sense to buy real estate? You know, is it good to have both? You know, everybody says be diversified. Today we have a guest who is going to talk with us. He's not local, but he is going to talk with us about what he thinks about investments and what he thinks about real estate as well. And one of the things that I just recently rolled out was my 0% interest to get your home fixed, to get top dollar. We have clients that are doing it, and it is turning out amazing. Their houses are looking great, and we can definitely help you with that as well. So if you're thinking about selling, you have some equity, but you don't have the money up front, definitely give me a call at 954-650-0827. Now, I want to welcome Brian Bingham. He is an investment educator, and he is in Missouri, which is about an hour, I think, behind us. And I wanted to welcome Brian. So welcome, Brian.
All right. Thank you very much. Can you hear me okay?
I can hear you.
All right. Very good. Okay. I didn't know. So, well, where do you want to start? Where would you like to start this evening?
So I know we had a little bit of a conversation earlier today about investments, and I was just curious to know what you think about real estate investing versus putting your money in the market. So tell me a little bit more about that.
Well, I'll tell you, give you a little bit of my background first that might help see my point of view. So when I was pretty young, I actually got involved in real estate at a young age. I worked at a lumber yard while I was in high school and college, and built my first house when I was 19. I was planning it my whole 18th year, and then started on the 19th. And within a year or so after that, I was actually building rental property. So I built some duplexes from the ground up, and so I've had a little experience with actually owning rental property. And all during that time, I was also trying to figure out how the stock market worked. And what I realized is that from the time I had a paper out at 11, looking at those big stock moves in the paper every day, most people I knew didn't have any idea how the stock market worked, including the professionals. And yet I knew a lot of people that knew how to build a house or, own rental property. So I started out with the rental property. And I think the common theme in all of this is, back then I didn't make any money in the stock market because I had no idea how it worked. And taking a hot tip from somebody who thought this would work or that would work was generally a bad idea. I went through the old penny stock, out of Denver, the penny stock news guides back when I was in high school, and that was a bad idea. Avoid the penny stocks like the plague. But what I realized is that real estate, you actually own something. If it's nearby where you live, you can actually understand it, and maybe understand what rents are in the area and so forth. So I'll come back to a long time ago. There was a quote from Warren Buffett, and most of you know that Warren Buffett's the chairman of Berkshire Hathaway and started out with relatively little and is now one of the richest men in the country. So what he basically said was that the only risk you take, and he was referring to the stock market, but it applies across all. He says the only risk you take is not knowing what you're doing. So before you get into either one, you really need to study and try to understand it. So I understood the real estate business because I'd been around it, and I had been pricing homes and properties since I was 11. I had the newspaper, I delivered it, right? And I always wanted to buy
Brian, you're supposed to be delivering those newspapers, not reading them.
Yeah, I know. I made a mistake. I learned how to read at a young age, unfortunately, right? So I read the papers, but bottom line is, once I got to the real estate side of it, I eventually built up to where I worked for a gentleman who owned hundreds and hundreds, 750 apartments and a lot of commercial property. And so I learned that side of it, and I can say that it's a very lucrative business. But you've got to start out with just getting your basic education, learning. There's in almost every town, and I'm sure you know this for your area, in St. Louis, there was a St. Louis real estate club, and there was a lot of incredibly valuable resources among people who had been decades investing real estate, and they were great resources. And some of those people, started out with one home, small, what they could afford. A lot of times, husband and wife, they go in on one rental property. But they learn the market, they learn the area, they do put a lot of thought and effort into it, and they try to do it as right as they can, so they know it. A lot of those folks started out in the 70s, and that was the time I was getting interested in this. I was 11 years old in 1976, and I remember that because my dad and I rode our bicycles from St. Louis to Marianna, Arkansas to visit some relatives that year. It's about a 400-mile bike ride. When I came back, I was really bored after that trip, so that's when I got the paper out. But anyhow, so the real estate, if you actually understand it, you can do pretty well with that. But at some point, you might want to move into the stock market, and a lot of times the two move differently. So I'll give you a quick look back at my youth and what I learned then that is still being used by me today to remember things and so forth. In 1966, the Dow Jones Industrial Average hit 1,000 for the first time. So if you're invested in an index fund, think about this, okay? You hear a lot of people say just invest in an index fund. Now, the S&P fund's a little more diversified. It'll probably do a little bit better. But the Dow 30 hit 1,000 in 1966 for the first time after a long bull market. It did not hit 1,100 until 1983. That was 17 years later. So you made 10% in 17 years if you had been able to invest in all 30 Dow stocks equally, or bought an index fund that represented that, which probably was not available at the time unless there was an individual mutual fund that created it. I think Fidelity used to have a fund that just traded the Dow 30.
So let me interrupt you real quick, Brian. Let me interrupt you real quick because,
Sure.
For our listeners, can you explain to them what a bull market is? I know what it is, but I want you to explain it to our listeners so that they can understand what we're talking about, because it gets very specific and there's a lot to understand when talking in these terms.
Right. Okay. So generally think in terms of uptrend and downtrend. When stocks are generally trending up in price, it's generally often considered a bull market. There's some definitions that are often used, but they can be rather misleading. Like when the market goes up 20%, it's called a bull market. When it goes down 20%, it's then called an official bear market. Problem is, if you wait for the 20%, you've missed an awful lot of the move frequently. So generally an uptrending market is a bull market. Generally a downtrending market is a bear market. And that comes from the old California bull and bear fights. So if you think about and this was a real thing, they had bull and bear fights in California, many, many years ago, in the Wild West. And the bears would always strike downwards with their claws, right? And the bull would always strike upwards with its horns. So that's where that came from. So now you can think of it like that. So during that period when the Dow went essentially nowhere for those 17 years, we had double-digit inflation for many of those years. And I remember enormous profits being made in real estate. So when you ask which is better, it really depends on what you know. With real estate, all you had to really do was own a home, and you participated because of inflation, and you participated to a great degree because maybe you only put 5, 10, or 20%, or 25, or even 30% down on the property, but the whole value of it appreciated at that inflation rate. So on your actual money you put in, you made a big return. If you own rental property, you did even better. but the stock market didn't do so well. We had high oil prices. And remember, when oil prices go up, you have to ship your goods, so your trucking costs are higher. If you need tires, they cost more. If you're putting vinyl siding on a house these days, it's made from petroleum. The sheeting around the wiring is, asphalt roofing. It all takes oil. So when you have those kind of things, it can kind of run your prices.
So let's take this, let's fast forward, right? So you were talking 1966, you're talking 1983.
Right.
Let's fast forward this to, let's take it from that time frame, and because you're a wealth of knowledge, and let's fast forward to 2005. And let's compare, and then we can bring it to the present, and I think that can help because I think a lot of our listeners, especially the realtors, they're like wondering, like, what do we know about this market, right? So you've, correct me if I'm wrong, like I heard you say, real estate is an awesome investment anytime, is what I'm hearing, but I could be wrong. You correct me if I'm wrong. And stocks can be... Yeah, stocks are a little bit more tricky than real estate. Real estate always seems to hold some sort of value, and it always comes back around again. And for me, being in this business for over 22 years, that is just factual. And, stocks are a little bit scary to people, and you're not telling people not to buy stocks, but you need to have a little bit more information before making that decision. So what we're going to do is we're going to go to commercial, and when we come back, let's go to 2005 so we can help our listeners understand, like, what was going on before, the middle, and then bring us to the present. So stay tuned. We'll be right back after our commercials.
Sure.
Whether you're buying, selling, refinancing, or building your dream home, you have a lot riding on your loan specialist. Max Fish, a top 1% mortgage loan officer in the nation, will give you a same-day qualifying quote. Max Fish is committed to providing his customers with mortgage services that exceed their expectations. Ensuring that you make the right choice for you and your family is his ultimate goal. Contact Max Fish today at 954-729-6933 or max.fisch@nwmcorp.net.
At Title Brothers LLC, our mission is to give you the best closing experience anywhere in the country. Founded in 2020 by Adam Lohman and Josh Wiseman, here at Title Brothers, we're your one-stop shop for residential real estate, title insurance, title and escrow services, real estate closing, and due diligence services. While primarily located in South Florida, we also host dozens of closings throughout the state and even electronically as requested. To contact the Title Brothers, call us at 954-995-4988 or visit our website and get a quick quote today.
You have been watching Making Money with Laura. For more information, contact Laura Sanders at 954-650-0827 or visit her website at theloracell.com. And now back to the show.
Hi, welcome back to Making Money with Laura Sanders, and I am your host, Laura Sanders. We have Brian Bingham with us today, and he's talking about, bear markets, bull markets. We're talking about, should we buy real estate? Should we not buy real estate? Should we buy stocks? Should we buy bonds? What should we do? Like, it's kind of confusing, right? Because you get scared. Everybody's like, oh, we're going to go in a recession. Oh, we're going to, one thing I can tell you, I don't care. I've been doing this for over 22 years as a realtor, 27 years as an investor, and I can tell you this, real estate always comes back around. It's one of the best investments you can ever make. So what I'm doing tonight is showing you what was going on before, in the middle, and in the present. So let's go to the middle with Brian Bingham. Welcome back, Brian.
Hey, thank you. Okay, so we're going to go back to 2005. And in 2005, I'll tell you a few things that I look at. And one of them in 2005 that stuck out to me is the housing stocks actually topped in July of 2005. So if you look at if you pull up a long-term stock chart of, say, Lennar, for example, or D.R. Horton or any of the large building companies, you'll see that they actually topped out. And I was mentioning to you earlier today that there was a company called AMBAC, which does a lot of the mortgage-backed securities. And it had topped out and dropped dramatically before we ever knew there was, the 07, 08 thing started kicking in. And So the stock market can often be used as a little bit of a tell for what's going to be happening in the real world in the very near future. It's more of a forward-looking indicator. You know, it's always looking forward 6 months to a year, and to, you know, presage economic conditions. So back then, the housing stocks topped fully, 2 years plus before the market did. And so then we moved into the bear market, everything gets washed out, we kind of reset everything. So now, after all those years of very low interest rates, we're finally getting back into that similar situation. When I talked about the 1970s, you have to remember, after World War II, we had very low interest rates. We had 0% rates and 1%, 1.5%, that area for a number of years. And as they went up higher, eventually we got into the 1970s. We had kept them so low for so long, we got that enormous inflation. Okay, so that was really good for real estate, but it became challenging for the stock investors. Now, I do want to back up and say one thing. There were many, many growth stocks that did incredibly well during the 1970s. Concepts like Sambo's Restaurants went up 500% in 2 years. Even McDonald's, 500% in a couple of years. There were the mobile home stocks, Redmond Industries, 500% in a little over a year, roughly, in the early 70s. So there were a lot of stocks. Wang Labs, the computer company, over 1,000%. There's always individual stock opportunities if you know where to look. So if you want a couple books to read,
if you know where to look, how do you know where to look?
Right. So I'm going to give you, I could spend 3 weeks talking about this.
All right, but we don't have 3 weeks, so let's do the concise version. Okay.
So let me give you a couple of quick books. Peter Lynch, one of the winningest mutual fund managers of all times, did it by picking individual stocks. And he will tell you how he did it if you read his book, One Up on Wall Street, or his other book, Winning on Wall Street, Beating the Street was the other one. And another excellent read, and the person I learned personally a lot from out in California, is William J. O'Neill, who wrote the book, How to Make Money in Stocks. And if you really want to understand the nuts and bolts of why some of these things work, you can also read Phil Fisher. And Phil Fisher wrote a book in 1955 or 56 called Common Stocks and Uncommon Profits. And then one more book I'll throw at you from 1930 is Why You Win or Lose. And everybody should read that book because it's got some real basic psychology. Why You Win or Lose by Fred Kelly. So let's move back on that. Those are some good books, by the way.
Send me those books so I can post them if you can. Like, text me when you get a chance, those books, so I can make sure.
I'll give you the.
I appreciate that. Thank you.
Absolutely.
In my
so
free
here's
time,
something else you can do. And right. And exactly. Well, I tell you what, I've got a list of books I spent 20 years reading. So I've got a list. You want more, I'll give you more. But if we come back to this, here's something that everybody out there can do right now to get some idea of which stocks may, and it's always may. This is a game of probabilities, okay? Everybody's out there trying to figure it out. And you actually have a bigger advantage over the professionals because they take 6, 7, 8 months or a year often to buy the stocks that they are going to own for 1, 3, 5, or 7 years frequently, right? And so they've got a big investment of time just getting their positions. You can buy and sell at the click of a mouse unless you're a billionaire generally, right? So you can be in and out fairly quickly. And to take a little of the mystery out of the stock market, the reason there's so many violent ups and downs during periods like this is because those guys are only going to buy so much stock. It's kind of buy 300,000 shares, buy 300,000 shares, sell 100,000 or 200,000 and knock the price back down. And then while everybody's scared, hurry up and buy it again, another few 100,000, then knock the price. So all that back and forth is accumulation. There's a way to read that. But what you can all do is pull up stocks that are on the new high list. And the regular new high list is not that important except in relation to, is it the first time the stock has hit a new high in the last 1, 2, 3, or 5 years? Because if it's right near that multi-year high, go back and look at a long-term chart of Microsoft, for example. Pull up a monthly long-term chart on whatever chart service you can use online, and stockcharts.com or Google Charts, perhaps, FinViz. There's a lot of them out there. And
you talked about penny stocks, though. But you talked about penny stocks. Wasn't IBM a penny stock at one point in time?
Microsoft was never a penny
Not
stock. I can't
Microsoft,
remember the price it
IBM.
came.
IBM.
Oh, IBM was. I don't believe Microsoft was ever, or IBM was ever a penny stock either. Many of these stocks, if you look at a long-term chart, they've gone up so much, and they've had so many split, 2 for 1, 2 for 1, 2 for 1. So a company that came public at maybe $25 or $35 a share, after so many splits, 35 divided by 2, looking way back, is 17 divided by 2 is 8 1/4, and on, so forth, 8.75, and on down and on down. And it'll look like it once might have traded at 12 cents, but it never did. Okay, so that can be very misleading. A lot of people get sucked into that trap of, if I would have only bought Microsoft when it was 12 cents. Well, it never was. Okay, so what you want to do is take a look at some of these stocks that are hitting new, fresh, multi-year highs, and you'll see right now there's some of these stocks, you've probably driven by a restaurant chain or two lately, that their stock, if you look at a chart, is either at or near all-time highs, coming out of very long, broad bases. Okay, and when they are doing that, it's not by accident. There's something specific going on at that business. Right now, there's some real transformations going on for many of the restaurants. Some of their digital strategies are adding a lot of value. And, the food inflation and so forth has helped out. It's actually made some of the restaurants, more affordable compared to cooking at home. That's some of the story. But there's a lot of those things you can look at. So the restaurants did good in the 70s. You may look at some of the restaurant names now, and I'll tell you, an underutilized, incredible value for the average person is you can go today, something you couldn't do when I was younger. You can go to the individual website, scroll down toward the bottom of the page generally, and find the little section that says Investor Relations, and they lay it all out for you. There's a restaurant chain out there right now, and I'm not going to get into any individual picks here, but you can figure this out pretty quickly, that has 2,000 restaurants, but they've got 1,100 others in development with franchisees right now.
Oh, wow.
And
so we're going to run out of time, let's jump over real quick.
Yeah.
So because we only have literally not even 2 minutes. So I told you it would go fast.
Right,
so let's do a summation.
Exactly.
So if we were to fast forward to today, let's just fast forward to today.
Yes.
If you were to buy stock, and nobody's holding you to this, what stock would you buy? And do you suggest that people should buy real estate or stock? What's your suggestion? And you've got 1 minute to sum it up.
1 minute to sum it up. I would buy what you feel the most knowledgeable on, always number one. If you're buying a hot tip, you've already set yourself up for failure. So try to learn as much as you can about the business. I'll remind you that Warren Buffett always said that, and his mentor, Ben Graham, if you can't afford to see your stock drop 50%, you shouldn't be in the market. Now, there's ways around that. Read those books. So Bill O'Neill, a specialist, show you how to cut your losses tightly. But I would actually, in this environment with high inflation, I would want to own real estate. And I would want to learn, if I don't know, I would want to learn about the stock market and always focus on individual stocks is my preference. But you got to do a lot of reading and a lot of understanding, and I've given some great valuable resources for that. But right now, I think in this environment, I would want to own real estate also, yes.
So, Brian, you're a wealth of knowledge. So if somebody wanted to talk with you to get more information, what would be a good way for them to reach out to you? And do you want them to reach out to you?
Sure. I do two things. I do both investment advice, coaching or consulting, or actually managing money through one business, Elite Investment Advisors. And my other business is Investor Education Network. I do webinars and emails every day. I don't have a website. I do it all through webinars and emails, and it's called Investor Education Network. And you can call me at either 314-983-0036. That's 314-983-0036. And that would be my money management line, and I can get you over to my other business from there. But 314-983-0036.
Thank
Brian
you
Bingham.
so much, Brian. We've run out of time. Thank you for joining us tonight.
Thank you for tuning in for Making Money with Laura Sanders, a name you can trust. To join the conversation, call us at the studio, 888-994-4995 Studio A, or contact Laura directly at 954-650-0827. Laura Sanders, a name you can trust. We look forward to seeing you next week.